Hello traders, Gary Wagner here just after 1 o'clock in Honolulu, 7 o'clock in New York. It is Wednesday, first day of July 2020, and this is the Daily Report for Gold and Silver. A strong upside move in gold last night took gold solidly above $1,800 per ounce. While I thought that pricing would hold, I was absolutely incorrect as short-term futures traders came in, pulling profits and taking gold down substantially, closing down in double digits by the close in New York. That did affect a trade that we put on. We'll speak about that in detail, as well as our current forecast for gold throughout the month of July. But first, to the price board. After trading to an effective close of approximately $1,800 yesterday, market forces took gold pricing dramatically higher in the evening session as it traded to an intraday high of $1,807.70. However, that price point was unsustainable, and $1,800 gold on a closing basis will have to occur at a later date because it certainly didn't occur today. The profit-taking and selling pressure that occurred once gold was above $1,800 took the August contract to an intraday low of $1,767.90. That is important. We'll talk about it during our technical studies before recovering at $1,779.30, but that still put it down about $21 on the day. Spot gold closed off by about $12 today, $1,769.70. That's a decline of about 0.7%. The EFT GLD did give up about 0.5%, 0.45%, losing 75 cents at 166.62. Daily Gold Miners Index gave up 0.42%, a drawdown of 33 cents, and closed at 77.85. All of the precious metals were under pressure, with platinum losing about 1.75%, 836.50. Palladium losing about the same, 1.75%, down $34 at $1,932.60. And lastly, silver lost approximately 2% on the day, a decline of 35 cents, still above 18 at 18.28. And that was all with dollar weakness providing tailwinds or supportive action. Before we take a look at a closer view, I do want to start today's show with a very macro view of gold pricing and the recent intraday high that gold achieved in trading last night. We are looking at a 2-week candlestick chart so that we can fit in all the data from the record high at 1920 all the way down to the end of the multi-year correction, end of 2015, beginning of 2016, and the subsequent set of rallies that we have seen since then, including this biggest rally, which we can see in a macro level, began middle of 2018 when gold was trading just under $1,200 per ounce to current pricing just below $1,800. Last night's high, and we just have a horizontal line, shows you that the high of 1807.80 surpasses any of the tops of the markets that came in 2012 and 2013. In other words, this triple top. If we look at the close today, it's currently trading at 17.80 and 40 cents. However, the macro charts do not speak to the extreme volatility that we saw in trading both overseas as well as New York today, because it was the intraday low of $1,767 and change that stopped us out of a trade alert that we sent out yesterday, as well as just prior to the opening of the New York markets for mainland subscribers. Traders taking the initial call would have got in roughly at 1805 and stopped out at our stop level at 1771, while those on the mainland sustained a much smaller drawdown, getting in roughly at 1782 with the stop at 1771, which resulted in a drawdown of $1,100 per COMEX contract. We also recommended that those trading the cash market could enter the market at 1767, a tight stop at 1758. The low today was 59 and change, which means that Forex or spot traders are still long gold at 77 with the current market price at 17.70 and 71 cents. Traders, while I acknowledge that today we saw gold sustain a strong drawdown, I do remain bullish overall. My primary rationale on a technical basis for that statement is if we look at a trend line drawn from recent lows, and I started that trend line from these lows down here. I then ran it to this low that came in at 1750. What you can see is that today's low is still above that particular trend line, and currently we are above that trend line. One of the reasons that besides futures trading, I am recommending that traders begin to rebalance their overall portfolios to include GLD and Nugget. And this is because GLD has no leverage whatsoever. Each share represents 1/10 ounce of gold, and Nugget has a very, very slight leverage of about 2x. So it lets us take on these positions on a much more long-term basis without really worrying about effective stops on a daily basis itself. Even if you had bought it yesterday, which it traded and closed at 167.35. Today's pricing of 166.62 would only show you a decline of about $1 per share. And when we look at Nugget, which has a little bit of leverage, about 2x, you can see that although it traded to an intraday low of about 73, it closed at 77.85, just shy of yesterday's close, which is what allows us to use these two vehicles for long-term trends without the same kind of concern about the intraday volatility as we get with trading futures. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow on Thursday for the weekly wrap-up and review. Bye-bye.